bro.
Why don't we get started? Pratt, are you there?
Yes, I'm here. We can get started. And
Why
yeah,
don't you get this kickoff? Yeah.
okay.
Why don't we
And I'm
get
gonna
started?
keep an eye on join channel. So
Pratt,
if
are you
anyone
there?
joins in, I'll just allot them guest
Yes, I'm
spots so
here.
they can
We
join
can
in
get
anytime.
started.
So yeah,
Why don't you get
yeah.
this
Let's kick in.
kickoff? Why don't we get
Hey
started?
everyone,
Why don't we
thanks
get
for
Pratt,
joining
are
us
you
today.
there?
I'm Brad. I'm an
Yes, I'm
L2
here.
contributor in
We can
DAO.
get started.
For today's knowledge session, we have partnered with AladdinDAO to host Boule research meeting. We'll be learning about Concentrator from DeFi Dead, who's an crypto OG. He's advisor on various projects like Zapper Finance, 35 and Althea AI. We also have Hassan today with us. They are VP and portfolio manager at Arca. They will be walking us through Beanstalk today. And of course, today's session wouldn't be possible without Charlene from AladdinDAO. Over to you, Charlene.
Yes. So thanks, Pratt, for making this happening. So AladdinDAO is an investment DAO focused on yield farming curations. And we have gathered a group of the most brilliant minds in crypto and DeFi to search for valuable DeFi protocols and farming opportunities collectively. We turn some of the best ideas proposed by our Boule members into products as well. And our philosophy is long only. So we aim to discover the most valuable DeFi protocols and we create strategies to help
I work with
Aladdin
for
and
LaFees. I work with Sharon, and we put together the cross procedures for LaFees. We had to build them from the ground up. Because Sharon and we got written, we got a recommendation from Finrun that we had to do cross trade procedures. So Eduardo, Sharon, and I had to go in and basically recreate them from scratch, put together a complete process document. But it's unique to LaFeast because it was like, this is what we can do. It wasn't rope. I mean, it worked.
So I just want to, give some background and why, we're having this meeting today. And what AladdinDAO does, and what's the purpose, and what's the mission behind the amazing book council we have. So I just mentioned that we actually take some of the best ideas from proposed by our Boule members, and we create strategies to help Aladdin and the general DeFi community to farm and hold and maximize their yields. And we're very excited to work with BanklessDAO on session 2 research meetings. And both of our communities are very research and learning driven. So really look forward to work with BanklessDAO and explore more collaboration opportunities. So I'll just hand it over to Hassan and DeFi that going to present money and also concentrator. Yeah.
DeFi Dad, you want to go first?
Yeah, no problem. That's what I was gonna see what your preference is. So yeah, hey everyone, thanks for having us. As Sherilyn framed up with AladdinDAO, our goal is to break down the walls of like asymmetric information within DeFi. And so every week we host a research call, and normally it's 2 of us that will present. Sometimes they're brand new money protocols or DeFi money protocols, and sometimes they're, in this case, actually today, I'm gonna present on Concentrator, which is something that we actually built through AladdinDAO, but it uses a lot of very familiar DeFi protocols, stuff that we've all been using and talking about for the last few years. So I think this will be an easy and very straightforward sort of strategy. Just quick reminder, none of this is financial advice. This isn't a recommendation or endorsement to use Concentrator, Curve, or Convex. And you should always be mindful of all of the risks to using DeFi, especially that you could lose 100% of your funds if there was an exploit. So, all right, on that note, let me get started here. I'm going to try to share my screen. I've never done this with Discord, so hopefully this will work. And actually, what I'm going to do, I'm just going to give some quick context to what is built with Concentrator, because a lot of these DeFi protocols, again, this is stuff that we've talked about in Bankless and other DeFi communities. So let's see here. All right, cool. If you can see my screen, just very briefly, the one of the underlying puzzle pieces to Concentrator is that we have staked ETH by Lido. If you're unfamiliar with this, you can earn 3.9% APR by holding a liquid staking version of ETH. So this is benefiting from ETH 2.0 validator rewards. To run a validator in Ethereum, and especially what's coming with the merge, you have to have 32 ETH. And that's a lot of money for most folks in the world. And so this is a huge innovation, over the last few years to allow someone to be able to basically use any minimal amount of Ether to hold or mint a staked version of that Ether. So for me, if I hold Ether as like a long-term store of value, which I do, this is a nice way for me to earn passive income and also support the the health and the staking behind Ethereum 2.0. Just double checking all. Okay, making sure that that's all showing up fine. Cool. So I'm not going to walk through this, but if you ever needed to mint Steth, it's here at lido.fi. The next piece, I'm going to share this tab instead. Next piece of the puzzle, which is, again, a very familiar DeFi protocol, is Curve. This is an automated market maker that has focused on pegged assets like stable coins and also like assets like Steth and Ether. So since Ether and Steth trade at almost a 1-to-1 rate, Curve has been the leading AMM for the last several years in creating deep liquidity for being able to trade between these two. One thing to note about Steth is you are not able to withdraw that staked Ether until we get to the merge, which for all of you in the BanklessDAO, you know about this because Ryan and David, I think, have done a great job of talking about how important this is to Ethereum moving to proof of stake. So normally you can deposit Steth and ETH, and I can earn trading fees. I can also earn Curve tokens if I stake the LP. So now we're at 3 forms of yield. Validator rewards for my Steth. I've got trading fees, and then we've got this like yield farming token reward with Curve. So then the last piece of the puzzle before we just briefly talk through Concentrator is Convex. Convex has sort of led what's now been coined as the Curve Wars. Because of the way that Curve is set up as a protocol in terms of the way it rewards liquidity providers, they have this mechanism where you basically vote by locking up the Curve token. And the more voting power you have, it's likely you're going to vote for pools that you have your own money in. And over time, that's gone from large, I would say whales that were holding Curve. It's shifted to quite a few DAOs that have seen a strategy whereby they use Curve to deepen their liquidity, to incentivize liquidity providers with Curve rewards. And a platform that has made that Curve war that much more competitive is Convex, where in Convex, you have, I think there's gotta be close to 100, or maybe it's 50 plus pools in here now that you can take the Curve LP, stake it, and then you are earning a boosted reward in terms of Curve, but you're also earning a new token, the CVX token by Convex Finance. So now I think that's the 4th form of yield that we've added to the equation. And so it's let me go back up to the top here. What many of us have been doing for quite some time is if I want 50% exposure to Steth, 50% to ETH, hold it as an LP in Curve, earn the trading fees, earn Curve rewards. I can boost all that yield and I can stake the LP here in Convex and earn an increased yield over what I might have earned just holding that in Curve. And so one of the I won't say it's a problem, but one of the challenges to earning more yield is as you earn, let me see here if I go over to, actually this won't do you any good. Normally you are earning that CVX and Curve in Convex, and you would have to come back and continually claim those rewards if you wanted to compound those rewards. So given the amount of fees that one might pay in transacting on Ethereum L1, I know in terms of my own yield farms, I would often not claim those rewards and just let them accrue, and at some point in time, go back and claim them. But if I can continually claim them and use those funds then to earn more yield farming rewards, now I'm increasing the total amount of yield that I earn. And so that leads us to, and this will be, with all that context, this will be much more painless to understand. What we've done with Concentrator is we've offered up some of the most popular pools. So the one that I've been alluding to the whole time here is Steth. And so if I hold that Curve, Steth, Ether, LP, I can deposit it here, and then I'm able to allow Concentrator to auto-claim my farming rewards, and then those rewards get swapped for what's known as CVX Curve. So for someone that wants to accumulate Curve, exposure to the price of Curve, which in this case it's CVX Curve, and that CVX Curve is also staked, so it's earning even more rewards. This is an ideal farming setup. So in most cases, the pools that we've enabled here are earning about 50% more yield than what I would earn on Convex. And so, despite the fact that we're all avid fans and power users of Curve and Convex, this is really I would compare it to, it's a very specific type of Yearn vault where our goal is to allow folks to be able to auto-claim their rewards and then compound those in the form of staked CVX Curve. And so you can see here, I'm earning, and this is, forgive me, I don't know if the numbers have updated on my open window here, but we're estimated about 8.05% APY. And then in Convex, let me share this again. In Convex, currently I would be netting a projected 6.5% VAPR. And if you go through some of the other pools here, sometimes the differences are a little more staggering, which obviously creates a little more incentive for someone to start to use Concentrator. Let me show this one more time. So I'll cap it off with this. Let me go back to our frequently asked questions. This is a nice little diagram of what's going on under the hood. So you've got your Curve LP. Let's pretend in this case it's the Steth Ether Curve LP. Once that gets deposited, or I could zap in with one of a few different tokens and not have to go create the LP. But whatever I use to deposit then into Concentrator, I've got certain earning. In this example, it's CVX, LDO, and Curve. And then all three of those tokens are being sold for CVX Curve, which is then staked. And the last bit of that is CVX Curve staked is earning about 40.7%. So that's just additional yield. This is probably the real icing on the cake for me in terms of why I can use Concentrator to increase my yield. Otherwise, those rewards would just be accruing there, and I would have to go in and manually claim them, wasting gas money, wasting time and effort. which is something I just normally wouldn't do. I would just kind of like wait till those rewards accrued to a larger amount. Versus with concentrator, I can allow concentrator to do all the work under the hood. One thing to note here is that service that is provided in terms of auto harvesting rewards and compounding them into staked CVX curve. There is a vault fee. There's a performance fee there, and there's a withdrawal fee. So make sure if you ever take a look at concentrator.aladdin.club, take a look at like the withdraw here, and you'll be able to see here we go, the vault withdrawal fees. So 0.05%. I think it's really important to just consider that before ever depositing into one of these. Because if you deposit and then withdraw shortly after, of course you could negate the whole reason of having earned yield in the first place. All right, I will pause there. Any questions about how this works? Awesome. Well, then I've done my job. If there are no questions, that's good. Here, I'm going to stop sharing my screen. And those vaults, if you take a look at those at concentrator.aladdin.club, most of the deposits allow for individual tokens. In fact, I think all of them now allow for individual token deposits. So previously, one would have had to go to Curve, deposit 1 or 2 tokens into that LP. And then once you have the LP token, you could stake it into Concentrator, which ultimately would then push it into Convex. But now you no longer have to do that. These basically look like zaps that you would use on Zapper. All right. Yeah, I guess unless there's any other questions, Hassan, do you want to go next and talk about Beanstalk?
Yeah.
Awesome. Hey, everyone, thanks for having us. And yeah, just feel free to reach out anytime if you are a builder, especially in this space. Please reach out to me and my team at fourthrevolution.capital. We'd be super keen to talk with you about what you're building. So.
Okay. All right. Thank you, DeFi Dad. I'm going to be talking about bean.money today. And it's like the overview of it's got a lot of terminology, but it works very similarly to how like ESD, DSD, and Basis worked. So if you have any familiarity with that, it would help. But here's the overview. So we're just going to discuss the protocol, how it works, terminology, the differences relative to ESD, DSD, and Basis and UST. Obviously, this thing was hacked a couple days ago for 76 million. And then we're going to talk about what they're doing to like the hack recovery plan. Okay. So this is an overview picture of how it works. In general, like the overarching concept is the same. Like when the price is over $1, new tokens are minted. 50% of those go to the DAO members. It's called the silo, and 50% of those go to the pod. The pod is like the creditors of Beanstalk. It's like when you buy Bean and give the beans to the protocol, and the protocol burns it. You have pods called debt, in other words. Okay. So the way this thing works is it looks at the price of Bean in the ETH Bean pool, and it looks at the price of Bean in the ETH USDC pool. The price of ETH in the ETH USDC pool. So if the ETH USDC pool is 110, but the ETH Bean pool is 100, that means Beanstalk or Beans is trading over $1. Remember, this is an algorithmic stablecoin, which should always be worth $1. So if the price of ETH Bean is 100, but the price of ETH USDC is 110, then the system will mint enough beans such that the amount of beans that it would take to bring the price of ETH Bean equal to the price of ETH USDC. So in this example, it would be like 10, right? The new beans which are minted when ETH is above $1, 50% of those new bean mints go to the silo, like I just said, and it's distributed, or the DAO, and it's distributed to LPs based on their ownership of stock. Stock is like your equity in the protocol. You earn stock from providing liquidity and holding beans and just being in the silo and not withdrawing your money. The remaining 50% of the beans that are minted go to pod holders or creditors on a first in, first out basis. I'll come back to this, but this FIFO method is very important. Beanstalk has no fixed APY. The beans that are minted are determined by the TWAP each season, so it changes. A season is an hour in the protocol. And so that was what happens when bean is over $1. When bean is under $1, it works similarly to how ESD and DSD did, in that there's an interest rate, which is called the weather in the system. And the higher the interest rate goes, the bigger your ROI is on extending credit or debt to Beanstalk. Essentially, like if the weather is 500% and you loaned Beanstalk, you would get 1,200 pods, and the formula is right here. Beans times the weather plus 1. So in my example, if the weather is 500% and you contributed 200 beans, if those beans ever become harvestable, or if those pods ever become harvestable, you would get 1,200 beans for your 200. So it's like a 6x. And this is the system used to kind of bring the protocol back into equilibrium when like Beanstalk is under $1. All right, so we're going to talk about the terminology now. We kind of like alluded to this as I was talking, but just to reiterate, sowing beans is like when you buy pods, like essentially you're lending beans to the protocol, which are burned. Pods are the debt asset. The pod line represents the debt of the protocol. The weather is the interest rate for lending, and a season is how often the TWAP is run. In the Beanstalk protocol, 1 hour, a season is an hour. Now we go to the DAO, or the silo, which is the DAO. Okay. When you deposit beans into the silo, you receive two things. You receive stock, which is like your equity, and you receive seeds. Seeds grow into stock, meaning if you stay in the DAO for a long enough period, all the seeds that you're earning, they grow into stock, and that stock determines what percentage of bean mints you get when the supply increases. So it's kind of incentivizing you to keep your ownership, stay in the silo, keep LPing, and earn more and more beans as beans are emitted. And here's the formula for, like, I'll distribute this after the chat, but like seeds yield 1/10,000th of a new stock every hour. So in other words, like it takes 416 days for one seed to grow into one stock, 208 days for two to grow into one stock, so on and so forth. And then this example, just to like hammer this point home, is about like how the stock works. So let's say there's stocks of the total stock supply is 90, and you deposit 90 beans into the silo. You get 1-for-1 on stock. So you get sorry, you just put 10 beans in the silo. Sorry, let me change that. So there's 90 stock, you deposit 10 beans in the silo, you get stock 1-for-1. So now there's 100 total stock. There was 90, you put in 10 beans, you got 10 additional stock. So now you own 10% of the silo. If 20 beans were minted because the price was over $1, you would get 1 bean. You would receive 1 bean or stock ownership. And the other 50% go to the pod holders. And these numbers are wrong. I'll fix them after. Basically, what I'm trying to communicate here is like, at the end of the day, what Beanstalk is trying to get you to do as an LP is to keep adding liquidity and stay in the silo and grow the LP pools. There's 3 LP pools. There's ETH Bean, which is like the ETH equivalent to ETH USDC. There's Bean 3 Curve, and there's Bean LUSD. And the more liquidity you provide in these pools, the more stock you get, the more seeds you get, and the more more the equity you accrue into the protocol is, which determines you getting more beans. It's reflexive on the way up like that. So now you're going to ask me, like, why is Beanstalk different than DSD, ESD, and Basis Cash? Like, what is better about this? What have we learned from prior algorithmic stablecoin protocols? The reason I think Beanstalk is interesting is because it's an elegant design, and it's unfortunate what happened in the hack, but the design is elegant. In DSD and ESD, what would happen is when the price of DSD and ESD were over $1, the protocols would look at price times total supply and mint that many new DSD or ESD tokens. So it just looked at the total supply of tokens. That's not really a good method because it ignores, like, the liquidity pool is what dictates the price of Bean. So in Beanstalk, it doesn't mint a ton of new tokens based on total supply. It just mints them based on a TWAP of the comparing the LP pools to ETH USDC. So if there's like 80 million circulating supply of Bean, but only 20 million are in the ETH Bean pool, it just mints based on the ETH Bean pool. It doesn't mint based on the 80 million. It mints based on the 20 in the ETH Bean pool. So it's not a ton of supply coming to market every day like it was in ESD and DSD. That's the first big difference, I think. Okay, then this is also very important, like the debt market. This is what I think is the most biggest difference between them. In ESD and DSD, lenders were incentivized to wait to get the highest coupon rate. And then when DSD and ESD traded back to like near $1, what would happen is there was first a bot war to redeem the coupon at $1. Like it was a gas war to get in because anyone could redeem right when it was over $1. So that was the first thing. The second thing is that whales didn't want you to the price to go over $1 because all of a sudden they're diluted, right? So every time DSD and ESD got close to $1, whales would slam it, making sure it stayed under $1 because they didn't want to get diluted and have all these people redeem the coupons. The way Bean works that's different is that it's first in, first out. And what that means is, like, if I, hold on, let me close this door. What that means is first in, first out means if I lend to the protocol when the weather is 500% and you lend to the protocol when the weather is 1200%, you can never go ahead of me. In other words, I can redeem my pods before you always. There's no one, you can't jump the line ahead of me. You can't like increase the gas and redeem your pods ahead of me. Like I always go first. And what this means is like you're incentivized to lend to the protocol earlier rather than later. Obviously later there's a higher ROI on the beans or on the pods, but like you can't jump me in line. I'm always first. And yes, my ROI is lower than yours, but my debt is also safer than yours. So that's another big difference between ESD and DSD. And then the third one, and we didn't really go into the example, so this one is a little trickier to understand without an example, but like there's a huge opportunity cost for withdrawing from the silo in Beanstalk. In DSD and ESD, when you withdrew from the DAO, you got to keep all of your rewards and you got to keep everything that you earned, right? And you could just like, there was a time lag. I think like ESD and DSD took 4 days before you could withdraw and sell. But in Bean, what happens is the second you withdraw from the DAO, all of your stock and all of your seeds, so basically everything that's giving you a right to income from the protocol is taken away. So you can't just withdraw all your beans and dump them if they're still accruing to stock. In other words, like there's just a high opportunity cost for withdrawing from the DAO. And you're decreasing your rights to future income moving forward, which is not the case in ESD and DSD. So I think those three things, which are very important, make the design a little more elegant than prior algorithmic stablecoins. Okay, almost done. I know I'm talking a lot, almost done. So then now why we're here, there was a big hack that was suffered by Beanstalk. It lost $76 million in a hack. The TLDR is that the hacker used a flash loan to exploit a governance design flaw, such that they were able to control enough stock and equity to take over the protocol, and then they just withdrew all the LP tokens to their own wallet, and basically, you know, ran the ETH through Tornado Cash, and they basically got away with $76 million. This was a governance design flaw. It was not an exploit of like the system design. The system had been working for 3 months. It's unfortunate that I can't show you Beanstalk. Like I can't get into the main page right now. You're seeing it, like it just doesn't let you in. But what you could see is that the price was stable for about 3 months. And so now Beanstalk needs $76 million. So what's going to happen? They're going to do a bean raiser or a public fundraise. Okay. They need 76 million to plug the gap or plug the hole. They need the 76 million in stablecoins or ERC20 stablecoins, because the system can just mint new beans to make the LPs whole for their beans, but it can't do it for the stablecoins. So what's going to happen is, depending on how much they can raise in the fundraiser, the bean mints moving forward, instead of being like 50% to the silo and 50% to the pod line, like the old system, in the new system, it'll be a third to the silo, a third to the old pod line, and a third to this new pod line, which is going to be generated from this bean raise. So the idea is to raise the 76 million, they'll start the weather for a new pod line at like 0%. And they'll start it, the weather will increase every 5 minutes. So the interest rate on this new debt they're raising will increase every 5 minutes. And presumably, after 3 days, they'll just stop it. And if they've raised the 76 million, they have. But if they haven't, they have to reset the system in a certain way. So what does this mean? They need 76 million. If they raise 76 million, everyone's made whole. If they raise 38 million, half, then all the LPs are going to take a 50% haircut on their LP position. If they raise 10%, same thing. You take a 90% discount on your LP position. So it really depends. The future of Beanstalk really depends on how much money they can raise in this public fundraise. The money raised will have like time vested liquidity. So if they raise the full amount, if they raise 76 million, everyone's made whole. There's going to be like, presumably you'd assume like the LPs, as soon as they get their money back, they would withdraw their money and sell. Well, you're not going to be able to do that. There's going to be time vested liquidity. So you'll vest to your liquidity 1% a day. So if you have 10 million bucks in there, or sorry, call it 100. I can't do math right now. If you have $100 in there, and after the first day, you'd invest $1 or $1 worth of your LP token on the first day. After 2 days, $2 worth of your LP token value, so on and so forth for 100 days. If you withdraw before the 100 days, you forfeit the rest of the rights to your LP tokens, and you'd get like 1/100th of your value. And you also forfeit all your stock and all your seats. So your ownership of the protocol gets distributed proportionally to the remaining LPs who stay in the system. So it's not going to be one of those situations where they plug the gap and then everyone runs for the hills. I'm sure some people will run for the hills, but the ones that don't, they will accrue more equity in the protocol moving forward from the ones that do exit. And yeah, I mean, there's a lot more stuff going on down here that you don't necessarily need to understand for Beanstalk, but I think the point of what I'm trying to communicate is that like for an algorithmic stablecoin, the yields were very high, but they weren't high in like a DSD ESD way where you're making like 12,000% or whatever. They're high to incentivize you to stay into the silo and build liquidity into the pools. And the deeper the pools get, the more stable the bean price gets. The more stable the bean price gets, the more confidence people have, so on and so forth. So at the end of the day, I think the future of Beanstalk is going to be very, very dependent on how much money they're able to raise in the Bean fundraiser. And that's going to be determined by basically who wants to put in. I've reached out to TFL, Terraform Labs. I think that Beanstalk, because it emits at such a high rate, Beanstalk could be used to basically take some pressure off Anchor and the Anchor yield reserve. If TFL puts in like 100 million, 200 million bucks or 200 million pods, they would get a really nice ROI on that if the system works, and they could use that yield to kind of subsidize the Anchor yield reserve, so the DAO doesn't have to burn a ton of Luna into UST to keep paying it out. So I've been talking to them about that. And yeah, I mean, that's pretty much it. I know I talked a lot. The terminology is confusing, but like if you just go through this doc, it's really not that hard. It just takes a second to get used to it. Let me know if there's any questions. If not, I'm done. All right.
Hey Hassan, I've got a question.
Yeah, bro.
You talked about the like the 50-50 distribution that was being converted into a 1/3, 1/3, 1/3 post hack.
Yes, sir.
Now, does that continue indefinitely? I might have misunderstood, and I'm wondering, does that have a like? Can we have the same confidence that the mechanism is going to work as well post hack as it did pre hack, even assuming we don't have like liquidity running for the exits or those kinds of issues?
Yeah, I mean that's a great question, dude. But so your understanding is correct in that like when we were 50-50, now we're going to go a third, a third, a third. This is done until the system pays off the debt, right? So long as there's debt, it will be paying a third, a third, a third. If there is no debt in the system, then what will likely happen is Beanstalk will not be over $1. Right, the price of Beanstalk will likely not be over $1, meaning that you're not going to be emitting new beans as often. If the price is under $1 or there is no debt, then the weather will likely increase, meaning that Beanstalk or it's called soil in the system. Soil is the protocol's soil is the amount of debt the protocol is willing to issue. So right now, when we restart the system, we are going to be taking on new debt. But as that debt's paid off, it'll be up to the protocol, the way the mechanism is working, to determine if it wants to issue more debt or not. And that's determined by like 5 or 6 factors, like, the weather, like the demand for bean, is there organic demand for bean or not, and things like that. But to answer your question, yeah, like it'll be a third, a third, a third until all the pods are paid off. Like, here's really quick to understand this. If you're like, let's say the pod line is 500 million, okay, there's 500 million pods, and the market cap of Beanstalk is 100 million. What that essentially means is if you're in the back of the pod line, like you're number 500 million, you own pod 500 million, for you to get paid on that debt, the market cap of Beanstalk has to grow to 1.1 billion. Because it's where you are on the pod line times 2, because it's 50-50 silo pods plus the current market cap. So it's now, basically it's to get paid on the pods, it's pods times 2, end of pod line times 2 plus the market cap. Now it's going to be, for all the pods to get cleared, it's pod line times 3 plus the current market cap. So it's harder. Yeah.
Right. And does that change like the attractiveness of taking on that system debt?
Yeah, no, it definitely does. Like there's definitely more risk now, right? Like previously you were getting half of them. Now you're only going to be getting a third of them. Your interest has been sliced in a third. So like really at the end of the day, if you believe in, so here's another way to think about it. Let's say they have to get 76 million they have to raise 76 million bucks. If they can't do that, if they cannot do that and they raise 40 million, then you have to make a decision of where do you think, which pod line do you even want to be in, or do you even want to be in it? Because now if you're in the back of it, it actually gets a little more attractive the less money they raise, right? Because the less money they raise, the closer you would be in the pod line, theoretically, if you wanted to lend to them. But I agree with you. It is obviously riskier now because you have to wait for longer to get paid. You own less of the protocol.
Do you think that affects the bean stability?
Honestly, no, because what I think is going to happen, I don't know how much they're going to raise. That's an impossible question to answer. I don't know how much. Like, obviously, if TFL comes in, they could just take the whole thing down, no problem. But like, if they raise the whole amount, I think that's a really bullish sign for the protocol because it shows like demand, and it does show me that the protocol can get to like 500 million to $1 billion in market cap. If they don't raise the whole amount, it gets easier to get paid on your pods. So it's like a risk reward thing.
Right.
Yeah, but it's tricky. There's a ton of game theory in this. I don't know that I would be buying the pods that are in the back of the line for the new fundraise. If I was going to buy this, I would do it immediately. Like if I was going to go and contribute debt to the protocol in the new pod line, I would go earlier rather than later, because I do think when the system restarts, you're going to get let's say, people take a haircut on their equity, or the LPs take a haircut on their positions. The closer you are, the easier it is to get paid. And the closer you are, as people put money in, that money is converted into bean stock, which raises the price of bean, which means that it'll be over $1, which means there'll be more printed. The further it goes out, the deeper the further back you are in the pod line. To get paid, the market cap has to grow, which means that the TVL and the pools is going to have to grow a boatload for you to get paid, which should help the stability of the price, but may not help you getting your pods, harvesting your pods, because you have to grow so much more, if that makes sense at all.
I think so. I mean, you got it's a question of how much you want to speculate on that, and maybe more speculators can like more speculators might drive actually some system stability, but it doesn't really help them necessarily.
Exactly. Yeah. So you're incentivized to ape early. If you're going to ape, you ape early. But yeah, no, I feel you. I really do think like this, if in a perfect world, one person with a very long run view of Beanstalk would just take the whole thing and just like understand that this is like a 1 to 2 year bet. Which is why I think like TFL and Anchor would make sense, because if it does work, like, if they buy $300 million worth of pods, that means that their return, if it comes to fruition, would be 300 million minus the 76 million of debt over, it would be over 76. What is that? That means they'd get like a 3x on their investment, excluding all the equity they would build into the protocol. So I hope they do it, but I don't know if they're going to do it.
Hassan,
Cool,
can
thanks.
you clarify one thing? So you mentioned that basically for this new pod line, like the weather or the interest rate is getting set progressively over time. So, as time goes on and they're not filling demand for pods, the interest rate goes up. So I'm curious, have you thought about like what are you, if you were to like do this, if you were to buy new pods in this new line, are you looking for a specific number? You said you would go early, but what does that mean as far as like, obviously you're not going to do it for 0%.
Yeah. I would definitely, like, that's a great question. I think, in my opinion, if you're going to do this, the weather's at least got to be 300%. So you're making like 4 on your money, right? Because the formula is like the number of pods you get is equal to the beans times the weather plus 1. So if the weather is 500%, you would be getting 6x on your money. I would at least be looking for 3 or 4x. It's just, theoretically, the system was really cool. Like before, I can't show it to you because the front page is down, obviously, but people were starting to make a market for their pods. So like you could go into the system and say, okay, this person is like 100 millionth in the pod line, and they're willing to sell these pods or these beans that you could harvest for 60 cents on the dollar, 50 cents on the dollar, 40 cents on the dollar. And so obviously the further back in the pod line these pods were, the cheaper the beans would be. So I think like the pod line, for example, the pod line was like 700 million long. The pods at 700 million were trading at like a nickel or less than a nickel. The pods at like 400 million were trading at like 30 to 50 cents, so on and so forth. So now when the system restarts, those pods should all get cheaper, right? Because now you're sharing into the equity of the protocol at a third instead of half. So if they do restart the system and you can buy and sell pods, it'll be interesting to see how people adjust the price of the pods in the system. But they should all get cheaper because you're getting sliced in your equity, if that makes sense.
Yeah, and this is all going to remain like they're not rebooting the system. Like all of this information, this whole pod line is going to remain intact as it was before the hack.
Yeah. They took a snapshot of the old pod line. They do have to restart the system because like they have to move to a new protocol, right? Because like the way it's going to work is when like they're trying to raise this $76 million. If they raise this money in stablecoins, they can just mint new beans to bring the LPs back to equilibrium. Like the system can mint beans and they can do this to like bring the system back to homeostasis. And then going forward, they have the old snapshot for the old pod line. They've raised the money so they know what the new pod line is, and it'll be a third. So, but you're right. That's a great point. The pods should definitely adjust in their price.
What's the market cap? Like how many beans were out there at the time of the hack?
Let's see if I can get this. Damn it. I think it was like 70-ish million. I can find this for you. Like,
Mine was 700 million.
yeah, the debt was 700 million. The bean supply was like, I think the bean market cap was like 70 million-ish.
Okay.
Yeah.
Yeah, it's a really interesting one.
Yeah. And like to put that in perspective, like if you're buying that 700 millionth pod, you're saying that the market cap of bean, you think the market cap of bean is going to like 1.47 billion dollars for you to get paid. You know, it's a 70x on your investment. So it's for the apes for sure. We'll see though. But I'll try to find that for you. This front page is down, so I can't get into anything.
Awesome. Thanks, Hassan.
No problem, bro. All right. Thanks, guys. Thank you, Charlene.
Do we have any further questions for Hassan and the DeFi Dad? If not, we're going to close the meeting because it's close to the hour. So thanks, DeFi Dad, and thanks, Hassan, for the presentation. Just never learn enough from you guys. And sorry for keeping everyone waiting at the beginning. This is a new format of research meeting we are experimenting. And so we will try to improve the process as we move forward. And thanks again for Pratt and everyone at BanklessDAO for making this happen. Yep, that's it.
Thanks, everyone.
Okay, all right.
Bye.
Thank you. Bye.
Bye.
Make sure you stop sharing your screen as well, just in case. Yeah, there we go. Nothing sensitive, but I'm gonna get that off.
I'll take the porn off.
Thanks for having us, everyone.
Bye, guys.
Have a good one, everyone. Bye.